Because in the last few videos we had a look at both Visa and Mastercard, I figured that for this video we're gonna have a look at American Express, a bit more of the underdog in the payment processor industry. And this is mostly because they run a slightly different business than Visa and Mastercard. Namely, Visa and Mastercard are purely payment processors, while American Express also has their own credit cards. And American Express very much focuses on a spending-centric model, which is to say that they like to attract the people who spend a lot of money and try to advertise towards them. Therefore, American Express is most of the time seen as a bit more of a luxurious and rich payment processor to have. You can buy one of their platinum credit cards for about $500 a year, which is not cheap, right? So they're very much focusing on the big spenders and trying to attract them. So let's have a look over at their financials here for the past 10 years. Let's see what they've been up to, and let's see whether or not we think that their business model is an attractive one and one that we can see ourselves investing in here in the next 10 years. So looking over at their revenue, we can see a very steadily increasing revenue growth of about 5% every single year, where we mostly see a very big leap here in 2021 and 2022 of 17 and 31% respectively. And I think the keen investor here will probably notice that their revenue growth is outpacing the actual inflation numbers, which means that American Express is still very much expanding their operations and not just growing with inflation itself. But the moment that we move over towards the EBITDA numbers, so the earnings before interest, taxes, depreciation and amortization, we have a slightly different view, because we notice that their EBITDA has been growing by around 1% annually. Now, of course, I do think it's important to note that this number is mostly lower because the final year here, 2022, is a bit lower than maybe we would expect by looking at that 10-year history. So the moment that we actually adjust this for maybe a bit more reasonable number that's maybe not as recession prone as 2022 is, because you have to realize that payment processors' earnings are correlated directly with the economy itself. At the moment that people stop spending money, at that moment American Express will stop making as much revenue as maybe they used to. The moment that we normalize this number, however, to around the $14 billion, we see an EBITDA growth of around the 3% range here. Looking over at that debt level, we can see that for the most part of the last 10 years, they've had a relatively high number of debt. 60 billion here in 2013, risen all the way to 66 billion in 2019, after which they reduced it to about 42 billion here in 2022. Looking at that debt level over here as well, we can see that they've had quite a steady debt level for the last 10 years. 60 billion in 2013, 66 billion in 2019, and they reduced that to 42 billion here in 2022. And I think the most striking thing about that is the moment that we look over at the next column, which is their excess cash. This is the total amount of cash that they have on hand, and we can see for the most part they've actually had quite a lot of cash on hand. Especially here in 2022, where they have about 34 billion in cash on hand with a debt of around 42 billion. So if they wanted to, they could pay down about 75% of that debt level right away. So if they wanted to, they could basically erase most of that debt, which makes it a bit of a safer investment, at least for the last 3 years, because they definitely were a little bit over leveraged here in 2019. Also looking at the net debt to EBITDA ratio, we can see it's well beyond the 3 times, which is the number that we tend to stick to consider a investment safe. So they definitely reduced their debt level and increased their excess cash pile, which makes it a bit more attractive for us as a safe investment here into the future. Excess cash has been growing from 17 billion all the way to 33 billion here in 2022, growing a lot faster than that debt level. Now, their market cap for the last 10 years has only been increasing by about 1.3% every single year, in line with their overall EBITDA growth. So we do not see much of a growth in earnings here for American Express, and we also don't see a big growth in market cap. But as we will see later down the line, the moment we start looking into their share price on the open market, we do see a very high appreciation, even though their market cap has not increased. But we'll get to that in a little bit. Their enterprise value is of course the entire value of the business. So we take the market cap, to which we then add the debt, and we subtract the cash, and this gives us the entire value of the company. Let's say a company like Visa would want to purchase American Express. Not only do they have to buy these shares from the open market, but they also have to incur the debt that American Express has, which is why we look at enterprise value. EV/EBITDA ratio is the ratio with which American Express traded. Now, this is the premium that you tend to pay for a stock, and for American Express, it's been around 12 times here for the last 10 years, which I do think is relatively low considering their very steadily increasing revenue, but of course their earnings has not grown all that much, so maybe this is the reason why their EV/EBITDA is always around the 10 to 14 times ratio, 12 times on average. Net debt to EBITDA, like I mentioned, during the early stages of this decade, they were a bit in troubled waters. They had well beyond the 3 times net debt to EBITDA ratio, but we can see for the last 3 years, they really pushed heavily on buying back that debt. They've really pushed heavily on increasing their balance sheet, where we now see a net debt to EBITDA ratio of 2.4, 1.5, and now 0.7 times here in 2022. So I do think it's fair to say that American Express is very unleveraged at this point in time because they have such an immense stack of cash on their balance sheet, which they can use to basically buy back a majority of their debt. This also means that they do have quite some wiggle room here to maybe do some acquisitions, some high value acquisitions, because they do have the leverage available to do so. Looking over at that cash flow here, now this is a very attractive thing to see for us as investors, of course, because cash flow from operations is all the money that the company makes simply by operating its business, simply by running their payment processing and their debit lines. This is how they make all their money. So we see in 2013 they made a cash flow from operations of 8.5 billion, which has risen all the way to an absolute record number here in 2022 of $21 billion. Capital expenditures, all the additional investment that they have to make to keep on operating their business in the future, any additional coats of paint, any additional renewal of infrastructure, anything that's required to keep on running the business into the future is included in capital expenditure. And because they are a payment processor, of course, there's not that much capital expenditure to go around. The moment that you look at, for example, a waste management company which has to buy additional garbage trucks, additional dump sites, additional infrastructure, they see a lot more cost in capital expenditure, while American Express mostly has to keep their payment processing infrastructure up to date, and that's really all the costs that they have. So that's why they see such a low capital expenditure and why the profit margins for American Express are so incredibly high. I did not add the column for added costs here, but I do think it's fair to say that for the last 3 years we see a lot of payments being made to really lower their debt level. Because the usual formula for free cash flow is when you take the cash flow from operations and you subtract the capital expenditure. And this is all the money that's available to you as the equity owner. And with this money, they can of course buy back the debt, they can issue a dividend, they can buy back shares, or they can do additional acquisitions. We can see for the last 3 years where they had a massive cash flow from operations that they use a large majority of this to really buy back that debt level, which is still very much in your favor as an investor, of course, because it means that the company is more healthy and more stable because of it. Nevertheless, we see a very steadily increasing free cash flow here, so a very steadily increasing pro rata ownership, or for you as an investor for holding American Express, of about 10% for the last 10 years. Now I do think these numbers are incredibly high, mostly again because even though EBITDA was low because their last year 2022 was low, their free cash flow number here is incredibly high of 19 billion, which is well beyond any other number they've posted for the last 10 years. So the moment that we actually try to normalize this a little bit more to see a more common trend occur, we see a free cash flow growth of around 6% overall. But of course, with the 2022 number, which was incredibly high, we see them at 19 billion. Shares outstanding, and this is the total amount of shares outstanding for American Express. In 2013 it was around 1100 million, so 1.1 billion, and in 2022 it is 752 million. So they've been drastically reducing their share count for the past 10 years. They basically bought back around 330 million stock and basically just ripped them up in your favor. 4% of the outstanding float has been reduced every single year for American Express, which of course skyrockets your return as an investor. Free cash flow per share. This is the moment that we take the free cash flow and we divide it by the amount of shares outstanding. The moment that free cash flow is growing and the amount of shares outstanding are decreasing, we see a very multiplicative effect here for the free cash flow per share. $7 here in 2013, $25 in 2022. Insane growth here for American Express. So let's see exactly what the stock price did here for the past 10 years. We can see that American Express traded for $90 here in 2013, and it's been trading for $149 in 2022. Now I do think the share price has come up a little bit since then, but this was the share price on the 31st of December 2022, an overall increase of 5% every single year, which is a lot higher than the market cap increase. Because of course market cap is calculated by taking the amount of shares outstanding and multiplying it by the price per share. And the moment that the amount of shares outstanding are reducing, of course the price per share must be increasing faster. So we see a price per share increase of 5% and a market cap increase of 1%. Free cash flow yield has always been around the 10% range, and this is mostly because their earnings are not growing as much here for the past 10 years. Even though their revenue is, and so is their cash flow, the earnings are relatively stable and growing by about 2%, which is about in line with inflation, so not much growth here to speak of. And this is also why we see American Express as being a more mature company and therefore trading at a lower multiple than maybe a growth company like Mastercard or Visa, which is still expanding heavily on different parts of the world. So let's see if we can make a forecast based on these numbers. So what I'm going to do here is I'm going to take the 2022 EBITDA numbers and I'm going to increase it by 3% every single year. Like I showed you just now, the moment I normalize this about in line with the trend, we see an EBITDA growth of around 3% annually. So I'm just going to take that number as a starting point and I'm going to reduce it to 2% here for the last 5 years. And some of you might say that 3% growth is a bit optimistic, and maybe you're right, but I do think it's fair to note here that I took that 2022 earnings number as a starting point, and this was a relatively low number considering the overall growing trend. So I do think that this compensates for the fact that I gave them a 3% EBITDA growth here for the first 5 years. I'm also going to attach a multiple of 13 times, even though historically they've been at 12 times. I do think it's a little bit undervalued considering the steady influx of money that they do have. I do think 12 times is a bit undervalued, so I'm going to give them 13 times here to be a bit more optimistic for their future. And this gives me an enterprise value 10 years from now of 194 billion, from which we then subtract the debt, we add the cash, gives me a market cap of 185 billion, divided by the amount of shares outstanding, and I'm assuming here that the amount of shares outstanding remain the same. Of course, if they buy back additional shares, which I think they will, considering their 10-year history, this is only going to be in your favor, but I can't really spend their free cash flow for them, so I can't really make that assumption. This gives me a stock price 10 years from now, so in 2032, of $247.14. And I'm going to do the same here for the free cash flow model. I'm going to grow it by 5% annually every single year, because the moment that we look at their free cash flow growth, we see about 6% annually. Now I do want to note that I took their 2021 numbers of free cash flow per share and not that 2022 number, because I do think that this number is a bit of an outlier compared to all the other numbers. So I want to be a bit more conservative with my free cash flow model projection, because looking at that 10-year history, we can see quite some up and down swings here. So I think taking the absolute highest number possible and projecting that into the future is a bit too optimistic maybe. So I took that 2021 number, which was still an amazing year for them, and I do think it's a very nice and conservative starting point. Then I'm going to grow it by 5% every single year, attach an 11% yield to it, and this gives me a stock price 10 years from now of $245.46. Right now on the open market, I can buy as many shares of American Express as I want for $171.72. Given both my projections, so the enterprise value as well as the free cash flow model, this gives me an overall share price 10 years from now of $246.30. This gives me a compounding annual growth rate, so an increase in stock price on the stock market alone of 3.7% annually. But the moment that we start to include the free cash flow that we projected here in our forecast and include that into our internal rate of return, I expect about 17.1% every single year. Overall, I always say that the stock market returns about 10%, so I think considering that, I think American Express will outperform the stock market by a relative margin here of around 7% annually at the current price. So let's see what happens if the price goes up or comes down a little bit. So the moment that the share price comes down by about 20% and goes back to the $140 range, I expect an IRR with my current conservative projections of around 22.1%. If it goes up a little bit to, let's say, $190, I am still interested in the stock. It still gives me a 15% IRR, which I still think is relatively attractive for any stock, and I'll happily take that. So this was it for American Express. Thank you very much for watching. Don't forget to like, subscribe, and all that good stuff, and I'll see you in the next one. Cheerio!